Good morning, my name is Przemysław Kwiecień. I'm the Chief Economist of the XTB, and it's my pleasure to have you on our weekly trading webinar, the first weekly trading webinar in 2022. So this is a great opportunity to discuss 2022 market outlook. So in today's webinar, I will start from the hawkish Fed story, because I think this is the most important thing that is moving markets these days, and this will be a good context for us to discuss a broader outlook for the year, and we'll finish with a quick overview on what to watch this week in terms of economic events. So let's start from the past week and what happened and what moved markets, which provides us the background for any considerations regarding the future. And for sure, the very important thing was a release of FOMC minutes from December, where already, we discussed this last year, when the Fed made this hawkish turn, let's call this, suggesting imminent interest rate hikes and increasing the pace of QE taper. However, the minutes went way beyond that, and even though market was already starting discussing and considering interest rate hikes for next year, I think that something that was completely not anticipated by market participants was a discussion on quantitative tightening. And as we can read from the minutes, participants actually think that this is appropriate to start reducing balance sheet of the Fed, not significantly beyond the timing of the first interest rate hike. As we'll show in the presentation in about a few minutes, this is something that in the past was very unfriendly for the markets, let's say so. So this is the big thing, big change, certainly, and something that we want to have in the back of our heads to start with. Secondly, we also had the NFP report on Friday, where on the surface it wasn't particularly great, because as you can see, this black line here, increase in employment was relatively benign, was relatively moderate. However, if you look at other statistics like the ADP, which was released on Wednesday, it was the strongest in a couple of months. On top of that, unemployment rate fell to 3.9%, and wages grew much stronger than expected by the markets. And as a result, this chart on the right, as you can see, the so-called wage bill, which is a multiplication of wage growth and employment change, it's still increasing at much faster pace than before the pandemic. So if you extrapolated this trend from before the pandemic, we are already higher by now, and we are rising quicker here. So from the Fed perspective, even with the weaker NFP, headline NFP number, and this is the situation where you get a stronger labor market. So definitely the story of the hawkish Fed is something that the market participants are paying attention to. But how will this affect markets in 2022? So let's start with the quick recap of the previous year. And as we can see here, this was a year of economic, I would say, not only economic performance, but economic and market excess or even exuberance. As we can see on the global PMI lines, the global one is the black one, the US is red one, and the gray one is global ex-US, which obviously is weaker because US was performing really, really well. But even if you look at this gray one, it was high on in the context of the previous, let's say, 10 plus years. And obviously in the US, it was unprecedented. The numbers were really, really sky high. But this was, of course, partly it was a result of return to a normal life from the pandemic. People started to spend money. Companies were able to, return to kind of quasi-normal situation of business operations. On the other hand, we also had very significant growth in tech as a result of pandemic. So there were obviously many positive trends. However, this economic excess. I call this because it was fueled by economic policies. First of all, obviously, monetary policies around the world with 0% or even negative interest rates, quantitative easings, but also fiscal easing with a lot of spending programs, aids, sending checks like the Biden checks at the beginning of 2021. So we had a lot of economic intervention, which has not been withdrawn in time, and because it has not been withdrawn, it caused inflation, and we need to deal with this now. From the market perspective, it was not only a reaction to this economic situation, but I would say even mostly, as we discussed on many occasions during our webinars, it was a result of over liquidity produced by Fed and Treasury, where Treasury decided to dump their huge cash holdings on the markets, and because there was so much cash on the market and investors didn't know what to do with it, obviously this led to very high asset valuation. So this is the starting point for 2022, and officially the outlook is good. I would say officially because this is market consensus from Bloomberg. As you can see, especially in growth, this is the chart on the bottom, you can see that even for not only for this year, because this is already very high, but even for next year, the consensus is higher than we had in 2019, which is the year before the pandemic, which obviously seems nearly unrealistic because we already have this fading fiscal impulse, all these programs, aids, and so on and so forth. Their effects are diminishing quite rapidly right now. Then we had inflation surprise, which means that people start realizing that while they got a lot of money, prices are also rising, and they cannot afford as much as they thought. So that will affect the demand in a negative way. We're still going to have a continuation of supply chain disruptions because of Omicron and all these, mostly in Asia, where they are really strict on this. This will have an impact on companies, so they will continue to have problems with adjusting to higher demand while it's there, and they may adjust to higher demand, to present demand, when it's no longer there. This is a real risk. And we still have high prices for many things, not only for consumers, but obviously also on the input side. But then again, even if that's the case, this is partly because, as you can see, in this index, which is Federal Reserve New York index, it's very slightly down from the peak, but it's only because the Baltic Dry Index, which takes into account freight costs, it tumbled from very speculative highs here, and not because underlying issues of restrictions and all this mess that this causes is over. Because from that perspective, we are still in the depth of the problem. Also, price pressures on the input side that might be decreasing slightly, I would say, but this is not enough to fend off global inflation. If you look at many commodity prices, not only these, the ones that you can see on Xstation, like you can see here, oil prices, look how quickly they recovered from this Omicron crash. Yeah, I mean, already back to the upwards trend. So even though there's many limits, and for the airlines, for the travel, oil prices are back to the rising trend. So are many other commodities like coal, like lumber. They're already rising quite quickly again, and that means that with economy still moving in a relatively rapid pace, there is no way that inflation can retreat in a significant manner in the short term. So yes, in the second half of the year, it is possible. Like if the demand declines, if people start withdrawing their demand, we can see maybe even quite significant withdrawal of inflation. However, for now, the pressure will be there, and it will push central banks to act. And this will be very important. From the market perspective, I would say that all the exuberances from last year, which is very strong equity markets, which is many situations on individual stock like GameStop or other things, which is also cryptocurrencies. This has all been caused by huge increase of money supply and over liquidity on the markets, where, as I said, investors didn't know what to do with their money, because if you have 2 trillions of US dollars or nearly 2 trillions of US dollars being parked at the Federal Reserve for nearly nothing, then it means that there is just so much money that needs to be somewhere, and of course there a lot of it lands in real estate, in equities, in cryptos, because investors have to do something with it. So as you can see here, over the last year, we had this money printing here from the major central banks like Federal Reserve, ECB, and Bank of Japan, but also we had delayed effects of this incredible money printing that the Fed did during the height of pandemic, and this money went to the Treasury, and then last year Treasury decided to just drop it on the markets. So we still have massive over liquidity, which I think is the reason that some of the markets are not really fully reacting to this hawkish Fed, because as you can see, for instance, if you take euro dollar, we already see quite significant reaction, especially from November. You can see that this downward trend, it accelerated, and even though right now we have some kind of consolidation, it's a flag formation, which is usually just a pause in the longer downward trend. So here we definitely see some I would say reckoning of what's happening. But then again, because of this over liquidity, we have a lot of complacency in equities. Even after last week's slight decline, we still have S&P 500 in the very middle of this unending, seemingly rising bullish channel. So I would say from this perspective, there is a lot of complacency, and for as long as this over liquidity is there, it will only have limited impact on the markets until people realize it's no longer there. So this is the real theme for this year, I think. As you can see already, even now, this pace of money printing has been greatly reduced, and if the Fed really does what it says it will, like reversing the balance sheet actions from the second half of this year, we may have a negative, let's say negative QE, which is quantitative tightening in the second half of this year. If you recall, this only happened once in 2018, and this was a very bad year for the markets, for pretty much all the asset classes, because if you withdraw liquidity, then everything, you need to be more selective with what you invest in. So I think this is definitely the story for this year, and we are in a situation which is unprecedented from many perspectives. Here you can see only some selected metrics like S&P 500 to GDP, which is 25% higher than at the pinnacle of dot-com bubble. You can see 2-year rally from the bottom, which is now over 100% for the first time in history, never been higher. Previously, when it was about 60-80%, it always led to at least some correction. And we also had last year the first situation where the margin debt for equities increased year over year by more than 60%, and it also didn't cause a correction for the first time ever. So just 3 indicators to show you, but pretty much it just shows how leveraged everything is, and that means that, like I said, we don't know it, because it's very likely that the Fed is scared at some point and they return to monetary easing if they're worried that the market pressure is too high. But if they really follow through on what they are saying now, this might have quite significant ramifications for the markets. I already showed you Eurodollar and S&P 500, on the Nasdaq especially, because this market is very prone to monetary policy. As you can see here, also we have a huge wedge formation, and we are testing a support right now. Today the markets are trying to recover from the very last chance of this kind of support, and it's going to be interesting in the short term if they manage, because if they manage, there's going to be another deep buying attempt, at least for now. But if they don't, we can have the first outbreak in a very, very long time. But many other markets are in quite sanguine moods, like the DAX, for instance, today already rising, very close to all-time highs, and possibility for a big double top here. But for now, markets are not really concerned about this liquidity withdrawal. And even precious metals, even though they are not rising and haven't been rising for quite a while, you can see that looking at the bond yields on the bond prices here collapsing, you could definitely argue that there is a potential for some negative surprise from gold and silver market as well, which is not that much above very crucial support point. Okay, let's move on to this week. Pretty much we only have one focus this week, which is US. As I said, 100% of the focus is on the Fed, and from that perspective, definitely you want to watch inflation figures on Wednesday, Thursday. On Wednesday we have consumer inflation, which is more important. So 1:30 p.m. is something that you want to watch for sure, because if, as expected, inflation rises above 7%, it will add kind of psychological pressure to the Fed, on the Fed to act even quicker. So definitely the data to watch. On Friday also retail sales. So I'd say the second half of the week is definitely US biased, kind of. But make sure to watch our news section on Xstation mobile platforms. We'll try to update you with all the market developments, those which are in the calendar, those which are not but happen anyway. So please stay with us, and we'll see each other next Monday again at 7:30 a.m. Have a great week. Bye.